Hi there, this is Jonathan Cameron, Certified Financial Planner at CameronDowning. Welcome. I'm here to give you the bottom line on disability income insurance. This is one of many videos we've produced to help you establish a firm foundation in your household. In previous videos, we covered budgeting and cash flow planning. We discussed the importance of the emergency fund and talked about foundational legal documents you need: a will, a living will, a healthcare power of attorney, and guardianship arrangements for your minor children. Then we discussed how life insurance is foundational to any financial plan. Now we need to talk about disability income insurance. This is very different from life insurance. In principle, life insurance pays your beneficiaries after you die. Disability income insurance, on the other hand, pays you while you're alive, but become disabled. A disability policy ensures your ability to make a living. Simple as that. It insures against the risk of losing your ability to make an income. Think about it this way. You need to ask yourself and be very honest about the answer. Right now, what is your single biggest asset? Is it your home? You have insurance on that, don't you? Is it your bank account? There's insurance on that too. I would argue that for most of you watching, your single biggest asset is probably your ability to make a living. What if you lost your health and you couldn't work? What if all of a sudden you had no income? It's an awful thought. All the financial planning you've done collapses if there's no income to fulfill the plan. Doesn't it make sense then to insure your biggest asset? This is what disability insurance is all about. So how do you get it? Often you can get it through work, both short-term disability, which usually lasts for 6 months, and long-term disability, which may extend your coverage further. One of the best financial decisions you can make is to elect as much disability insurance as you can get through your employer. First, your company is likely subsidizing much of the premium, so it's a benefit you should not leave on the table. Individual policies are also available. What you buy individually outside of your job will give you a tax-free benefit, since you're not going to be deducting premiums. As a rule of thumb, disability insurance usually covers about 2/3 of your income. Typically, it's not the full 100%. If that income is coming to you tax-free, as would be the case with policies you individually purchase outside of your employer, having coverage of 2/3 of your income may be just fine, given that you're not having to pay any taxes on the income benefit. You can buy policies that cover you for a period of years, say 5 or 10 years, or up to age 65. There is financial as well as medical underwriting, so you'll need to have the same kind of medical exams you'd have for a life insurance policy. But you're also going to need to demonstrate income that you want to insure with tax returns, or maybe your employer has a statement they can make of your salary. Also, when looking at disability insurance for my clients, I never show them the cheapest plain vanilla policy. This is not like buying cheap term life. There are some add-ons, or what we call riders, that you should include in any disability policy. Otherwise, you run the risk of having a weak policy that won't pay you when you really need it. In this video, I'll mention 3 or 4 add-ons that you definitely want to have. First, the most important add-on is having a strong definition of the word disability. This is extremely important. Insurance companies offer disability policies that define the word disability in different ways, so you need to be very careful about which policy you choose. We'll save you the trouble. Look for a policy that has an own occupation definition of disability. That's OWN. Own occupation policies may also be referred to as your occupation. So what does this mean? It means you're insuring the occupation you're trained for. Here's an example. Let's say you are a surgeon and you have a terrible accident and you lose a hand. Now, because of this accident, you can no longer perform surgeries in the operating room. However, you can still continue working as a medical doctor, maybe as a researcher in a lab or another field of medicine. With an own occupation rider, the policy will pay an income benefit even if you can continue to work full time after the accident. The key here is that you can no longer work at your own occupation, so your income benefit is triggered. In theory, then, this allows you to double dip. You'll receive the policy income benefit in addition to your salary at work. You will pay a little more for this, but the rider is not terribly expensive. It can potentially be very expensive if you do not have an own occupation definition on your policy. This is the strongest definition, and you won't want anything else. 2. Look for the residual disability add-on. What is this? Say you have an injury. You can still go to work, but now you're unable to perform some of your responsibilities, or you can only work part-time. In broad terms, the residual disability add-on provides a proportional amount of benefit for your partial loss of income. Read specific definitions for residual disability in your policy, but adding this rider strengthens the policy, so it's more than just all or nothing. This may allow for a proportional benefit if you're partially disabled. 3. You'll want an inflation rider, generally 3 to 5%, so that the benefit you purchase today will rise automatically throughout the years. You want your policy benefit to grow over time to keep up with the cost of living, especially if you're in the position to make a claim many years after the policy inception. These add-ons will increase the premium on your policy, and typically you cannot add them after the fact, but you'll be happy you gave yourself the extra security in the event you lose your ability to make an income. You get what you pay for, so make good decisions now. For a very, very rough estimate, the cost of an individual policy is about 3% of the income being insured. So if you're insuring $100,000, you can expect a premium in the range of $3,000 a year. The younger and healthier you are, the cheaper it will be. As I said, this is crucially important piece of any financial plan. If there's no income, everything else falls apart. So please, do not overlook this. Now, let's address the young physicians and attorneys watching. Even though you're not making much now and you're saddled with student loans, imagine if you became disabled and not only could you not do the job you trained so hard for, but you're also burdened with a huge debt that you don't know how you will pay off. Open a disability policy now and ensure the income you do have. There are a few other add-ons or riders that allow you to increase your future income benefit without new medical underwriting. It's worth the investment in yourself, and we would be happy to find the right disability policy for you. So get in touch, and we'll let you know what's good out there and what's not. This is Jonathan Cameron, Certified Financial Planner at CameronDowning. If you're considering a disability policy for yourself, let us know. We'll help you make an informed decision. Connect with us on Facebook, Twitter, LinkedIn, and check us out at CameronDowning.com. We'll see you soon.